Volatility in the markets have continued in November, and we've got more information now also concerning the growth outlook for the economy next year. And in contrast to the situation in October, we've also seen actually interest rates markets move.
Yes, there definitely seems to be quite a lot of uncertainties relating to economic growth and political situation in various countries as well. But if we start with the interest rates, the most significant change during the last month was the Federal Reserve head Powell saying that the current interest rate they have is only just below the so-called neutral rate. And in contrast to what the central bank has communicated earlier, this is quite a big change since earlier they said that they are significantly below the neutral level.
But still, one interest rate hike is priced in for this year that we will see now in December.
Yes.
But the expectations now due to this comment for next year have actually decreased. So only perhaps one interest rate hike priced in for next year, which would mean that neutral level that Powell is talking about could be at or about 3%.
Yes, so the markets are definitely expecting less hikes now than they are or were before the comments. And the central bank in the US is probably coming closer to a situation where they will say that future rate hikes will be dependent on economic data.
Right. But the problem for the central bank is, of course, that the jobs market is still very tight in the US. We still see wage inflation at about 3%, so slightly above their 2% inflation target as a whole. But on the same time, we see growth slowing outside of the US. So, yes. So the problem perhaps for markets now, and one of the reasons why we've seen volatility is sort of which of these factors is the central bank going to weight next year? Are they going to weight the fact that the jobs market is still tight, or are they going to put more weight in their communication and actions on the fact that growth is slowing outside of the US?
Yes, and one other factor which they also need to take into account is, of course, oil price, which eases inflation pressure. And since the oil price has started to decrease or come down since October, the inflation expectations in the markets have also started to come down a bit.
Yeah, they have moderated as well.
Yes.
So we've seen interest rates turn down, and in the US, the 10-year government bond is now below 3%, which is a quite big change from the situation in October. Now, if we go through the reasons for the decreasing growth expectations outside of the US, if we start with China, we've seen slightly soft data both on the export and on the import sector, but then also we've seen, for instance, car demand declining in China quite drastically.
Yes, part of the exports and imports effect has been, of course, due to the trade tariffs. But it seems that the trade war doesn't explain all of it. So the Chinese economy has been slowing down since summer, and this would have happened despite the trade policy. All the same, the economy, of course, is still growing quite fast if you compare to the Western markets.
So still expecting about 6.5% for next year as well, economic growth in China. But the longer-term trend is, of course, that China is transforming itself from a fixed investment-driven economy to a consumption-driven economy. And that transition, of course, will not be linear.
Yes.
And so one of the underlying factors is, of course, this. And then we have the trade war rhetoric and the effects of that also acting negatively. But on the trade war side, we of course had the G20 meeting at the end of November, and we got a slightly more positive signal from that.
Yes, and that's definitely one step in the right direction. Of course, we are still far from an overall solution. For example, regarding foreign investments in China. One of the things the US have or wants from these trade negotiations is better protection for intellectual property right when they invest in China, and this is still on the table.
Yeah, the property right issue is probably the hardest to solve. Everything else is a byproduct of that.
Yes.
But we now have a 90-day truce from the end of November, which means that we will see now the first 2 months of the year going in interesting terms concerning this trade rhetoric as well. We've gotten some disturbing news as well concerning the Huawei chief also being arrested in Canada, which also has spooked markets because there are, of course, some parallels to the trade talks here going on. But this story will continue and we will follow that closely. But moving on from China to China's trade partners, of course, in Europe, we've also seen slowing economic growth, and especially going back to the car demand issue, we've seen slowing growth in Germany.
Yes. And this partly is due to the trade war as well, but car sales in China, for example, have decreased quite a bit, and this affects the German auto manufacturers and indirectly other European countries and economies as well.
For instance, for Finland, Germany is the largest trading partner, so,
yes.
So the effects will, of course, come with a lag as well.
Yes.
But in Europe, of course, we have other issues of concern. Italy is still negotiating with the EU about the budget deficit. That seems to be now panning out in a slightly better manner. We've seen Italian bonds trading a little bit more narrow compared to German bond yields. But then the Brexit issue is, of course, something that is highlighted in the media quite a lot.
Yes, and this will probably continue into January as well, as they postponed the vote in the British Parliament.
Yeah, but the most important factor for Europe is still the German economic growth picture and how that will pan out.
Yes. In the middle of the uncertainties, I think a sensible way to look at this is to follow fundamentals. One of the factors I would now look closely at is earnings growth. And actually, in earnings growth, we've seen somewhat negative developments in recent months.
And there's three factors concerning that. First of all, there's the underlying softness in the growth picture and expectations for next year coming down.
Yes.
But second of all, we have two sectors that actually explain a large part of this decline in earnings expectations.
Yes, first of all, the technology sector, which is quite an important part of the economy globally. The earnings revisions have been quite substantial with the technology companies. The second is of course energy, which links to the oil price.
And both of these two sectors have been one of the fastest growing sectors during the last 3 years. So they have explained a lot of the underlying fundamental support for the markets during these years. So this is also a quite large transition as well.
Yes.
And in relation to this, what we have transformed our positioning also in the equity allocation to a more defensive stance.
Yes, over this year we've gradually made our equity positions somewhat more defensive. First of all, by decreasing the weight of US technology companies. Secondly, by reducing the weight of small caps globally. Small caps usually are more sensitive to economic upswings and downturns, so reducing small caps makes the portfolio somewhat more defensive. And then, of course, we've increased companies which are more stable and operate in sectors that overall are more defensive.
But in addition to this, we've actually added emerging markets. So even though the growth picture in emerging market has been a little bit more slow or slowing down, we've still seen emerging markets being in a relative sense attractive due to the fact that we've seen emerging market currencies stabilize.
Yes, emerging markets is perhaps the bright spot in the middle of the market turbulence. And this is, as you said, due to the currencies. Over the summer, emerging market currencies devalued quite a lot. This stabilized around September, which is a good news for the emerging economies. And now, in the beginning of December, the comments made by Powell regarding the rate hikes or current interest rate level means that the dollar may not strengthen as much as it has this year, which, if it happens, would be a good news for the emerging economies.
And we've seen both actually emerging equities and also emerging market bonds outperforming on a global level.
Yes.
That's all we had this time. You can follow us still, our commentary on Twitter. On the webpage, we have our latest allocation view and also our market outlook. In the meantime, we thank you for watching these market outlook broadcasts this year. And we hope you have a very good festive season coming up here in the end of December.
Thank you.
Thank you and goodbye.